All right. Thank you, RJ, for hosting this course for Mortgages for Landlords, an introduction level. We're so happy that you could give us your time today. We thought maybe we would start off a little bit about, your background. You said you were in commercial lending and now over to residential for the past 10 years. So I know you come at us with a vast amount of knowledge. How do you think that, those two industries play together with your knowledge for what you do now?
Sure. The commercial industry is quite a bit different, and a lot of the factors for how people qualify are unique. But at the end of the day, it's really just helping people get to where they want to be, whether they're private investors, if they're large companies that are trying to invest, or individuals trying to buy their first home. I've learned different strategies through the years that work, and I apply those to each of my customers.
Awesome. Now, what is the difference between an independent mortgage broker and maybe one at like Chase or Navy Federal or Wells Fargo? Tell us a little bit about what a landlord's options would be. What type of people could they reach out to in the mortgage industry?
Sure, that's a great question. And brokers are really, it's important that you understand that difference. What a broker is someone who has access to hundreds of different lenders throughout the country. So when we have an applicant come to us, what we do is take a look at all their credentials, and then we try to find the right product for them based on all the lenders we work with. Now, if you were to go to a Wells Fargo, a local credit union, or one of the other banks that you mentioned, they have a set of programs that they have to work within, and then they try to fit you within that program. If, for instance, they don't do VA loans and you are a great candidate for a VA loan, they're probably not going to mention that product. Whereas a broker in our world, it makes no difference which product you go into us. So it's to our advantage to make you or find you the best deal.
Yeah, I think I was just talking to a friend who was buying her first home, actually. And I strongly suggest, for me personally, I know it's not for everyone, but I like working with a broker for what you just said. Sometimes there are deals out there that I didn't even know existed, but a broker will shop around for me. And I was explaining to her that it's just so much easier to have that one person that you go to. So even in the purchase, when purchasing a home, you get that pre-approval letter. But if you need a new one for a new contract, a different amount for a new contract you're going to submit, when you have that one person to call up who just really knows your situation, it makes it so much easier.
Yeah, absolutely. A couple other things worth noting. Most brokers work 24/7. So meaning if you're putting an offer on a Saturday night, you're going to be able to reach us. Whereas Wells Fargo, when they leave, at 3 o'clock or 4 o'clock, whatever time it is, it's nearly impossible to have contact with them. The broker world also, a lot of people deal with their local banks, and that's where they get stuck going to a small credit union to get their loan. And they do it because of familiarity. In society, we shop for everything. I drive across town to save 5 cents on gas. So why wouldn't you take a little extra time to maybe work with a broker, give them your information, and save thousands of dollars?
Let's talk a little bit about why it's so important that you're open 24/7 about that pre-approval letter. I know a lot of people are like, why do I care? 8 to 5 is fine. I can't go to the teller, so why does it matter? Can you talk about the pre-approval letter and how that needs to match every offer and why that's so important of having that access?
Yeah, sure. I can't tell you how many times I've talked with someone initially and they were kind of interested in purchasing a home. And when we did the numbers and they realized it was a lot closer than they thought, they started looking. And inevitably, they look on a weekend when they don't have to work, when there's open houses. And all of a sudden, they find the house of their dream at 5 o'clock on a Saturday, and they need help. They need to put an offer in. And most realtors will not accept an offer unless it comes with a pre-approval letter. So what a pre-approval letter is it's a letter, defined by the name of it. But what it tells the real estate broker is that you've taken the necessary steps to show through documentation and through your application that you qualify to purchase this home. So someone has scrutinized it. A lot of times we run it through our system. We have an automated system which gives an approval. And that is what that letter represents. and if you're dealing with the bank, there's a slight chance you might get a letter at 5 o'clock, but more than likely you're going to have to wait till Monday, and you're going to lose a competitive edge to maybe get that house under contract, because they may stop accepting offers on a Sunday night because they want to start the week with an offer in hand.
I've had a broker help me so much, like even if that pre-approval letter, I think I'm looking at a property for, 300,000, but then I find this great deal and I want to offer 275, and I ring up the broker and say, hey, zap me over a 275 approval letter, because I'm certainly not going to let the seller know I can go up to 300. And I mean, I'm honest, that has saved me so much money over the years of buying property. So I mean, I cannot stress how important that is to have that relationship and be able to do that.
Well, yeah, because your offer has to match your letter. And I don't know about you, but I never know what my offer is going to be. And heck, it oftentimes changes 7 times, because I say I want to offer 240 and I end up having to offer 297, 500. So
before we launch into too much more, mortgage talk, I think it would probably behoove us to review some, what we would refer to as standard terms, but to our audience, we don't want to launch into some deep conversation using terminology that maybe they aren't familiar with. So when we talk about interest rates, there is all types of interest rates. So could you expand upon, what is an interest rate and what are the different types?
Absolutely. So, I mean, I think what most people have grown accustomed to, especially in the US, is our 30-year fixed interest rate. And that's something we should be proud of, because a lot of countries don't have a 30-year mortgage. Our neighbors to the north in Canada, they amortize their loan over 30 years, meaning their payments based on 30 years. But every 5 years, they have to renegotiate their interest rate. So having the ability to get your rate locked in for 30 years without any penalties for selling the house or for moving on or paying it off is just an amazing thing. And that's something you should take advantage of whenever you can. Because if you were to, get a fixed rate mortgage today at, let's just say, 6% interest, if rates go up, you're extremely happy, right? If rates go down, you can always renegotiate and you can find yourself in a better position, and there's no penalties for that. But as you mentioned, there are other types of interest rates you're going to hear. There's variable rate mortgages. A lot of times they refer to those as ARMs. So what that product does is it gives you a set interest rate for a period of time, like let's say the first 5 years. And then after that, the interest rate can adjust from that period on. Now, there's certain situations when those make sense. In today's market, there are very few adjustable rate mortgages that make sense over a fixed product. And that's simply because the market doesn't have an appetite for them, because there aren't any, there's no certainty about the future. They're really feeling uneasy. So, I would caution people at this moment against ARM products. There's 1 or 2 good ones, but really the fixed rate is the way to go. Other things you're going to see when you're talking about interest rates are the time, a 30-year versus a 15-year. Certainly, if you can afford a 15-year, you're going to save a lot of money in interest, because interest compounds, and an additional 15 years is quite a bit of extra money in interest that you'll pay. But you have to weigh that out with, can you afford the extra payment? Is it going to change your lifestyle? We certainly don't want to get into a mortgage that is making you uncomfortable. And that's why the 30-year product is so popular, I would say with 99% of who we work with. And a lot of times the rate difference isn't worth it. Really, if you can afford it, compare the difference in rate that you're going to get, because you can always pay extra on a 30-year mortgage to make it a 15, but you're not bound to that larger payment. And that's real. I mean, when you talk about interest rates, those are, I would say, the main ones that you're going to see: ARM products, fixed rate, and then the different terms.
And then the 15, I think you touched on it a little bit, like the 15-year versus 30-year, those rates would be different, but then you're bound by the 15-year payback time or term.
And strangely enough, it's really a factor of the market. The 15-year is, like during COVID, was not better than the 30-year.
Okay.
They were exactly the same. So it's not a given. It's something that you need to research. And then another, we talked about working with brokers. One thing that we have access to, a lot of people, and I know this course isn't about refinancing, but they are refinancing a loan and they have already paid 5 years and they want a 25-year mortgage or a 26-year mortgage. You know, if you are working with a great broker, they're going to be able to present you with options where we don't change. When you do get a lower rate, we don't change the number of years left on your payments.
Okay.
That's actually really cool. I actually really like that.
Give you more options or a little flexibility even.
Yep.
Yeah. A lot of people, after you paid for 12 years, don't want to reset the clock.
Yeah. So we've talked a little bit about, you know, the pre-approval letter and the interest rate you need to take into consideration. What are points and what do they do?
Sure. So, and points is such a weird name. I mean, it doesn't really make a lot of sense to most individuals. What a point is, or another word for it would be a buy down. You know, when you pay a point on a loan, you're paying to reduce the interest rate. Unfortunately, some people also term points as the fee for administering the loan. So you may say, okay, here, your interest rate's 6.5%, and we're going to charge you 1 point. Well, if you think of the word point, think of it as a percent. I am paying 1% of the loan amount in order to have this loan completed. So two ways to think of point, or there's 2 ways points are used. One, as a straight fee from your lender. That's what percentage of the loan they're charging you to do the transaction. And then on the other side, you can use points. Once you have your loan all set up, you could say, well, how much is it going to cost me to buy this interest rate? And you'll be quoted a lot of times in points. It's going to cost you 0.5% of the loan total amount to get this interest rate.
So people could use points in a couple of different ways, either to buy down the interest rate on their loan by tacking money onto the total that they're going to owe, or they may use points as like a lender fee. Would that be the right term?
Yeah, I mean, typically they live in 2 different worlds. If you're working in jumbo loans, almost always they'll say there's a 1% origination fee. You're paying 1 point to, you know, and I think that word sometimes is misused.
Yeah.
But just understand that some people will use that jargon for both things.
Well, speaking of jargon, RJ, tell us about what a jumbo loan is.
Yeah, I guess I got ahead of myself. So we're going to get into the different types of loans.
Just very briefly, just as like a definition.
Sure. A jumbo loan is simply a loan that's over a certain dollar amount in your county. So the government or Fannie Mae, Freddie Mac, they put together loan limits in each area. For conventional loans, you know, another word for conventional loan is just, I guess, normal, average, the regular product. And once you go above that product level, you need to get into a different product. And jumbo is the most popular for higher price loans.
Okay. And,
I shouldn't say higher price, higher value loans.
Higher value loans. And I know you said it might depend on a county. Is it wildly different in counties? Okay. So
yeah, very much so. It's based on every year sheets released, and sometimes it's updated throughout the year, that says the maximum conventional loan limits in each county. So if you're working with a lender in your area, or even with not in your area, they can Google it. I mean, you can Google it. It's very simple to find. And you'll see, like in my county, the loan limit, I believe, is 756. So once you go above 756,000, you have to start looking at different products.
Okay.
And that's in loan, that's loan amount, not purchase price.
But doesn't the reason why the word jumbo matters is because doesn't that affect your rate if you go into a jumbo? So like a jumbo loan and a regular loan have different rates. And don't they also have different down payment requirements, or am I misspeaking?
Yeah, you're 100% right. Once you cross over that board, and we're going to talk a little bit about this, like what we call QM, qualifying mortgages versus non-qualifying mortgages. Once you move into that realm of jumbo, it's a whole new set of rules. Every lender, every investor, we call them, people who buy the loans, will have different requirements.
Okay. So, sorry.
No, I was going to say is, if you are playing in that world, just know that if you're approved by a Chase jumbo, it doesn't necessarily mean you're going to be approved with a Wells Fargo jumbo, because they each have their own product. It's very specific. It's whatever they're looking for, whatever they feel comfortable with in the times.
Okay. Maybe whatever is going to fit best in their portfolio at that given moment.
Exactly
So
right.
If we're using a broker and not like Chase or Wells Fargo and Navy Fed specifically, how does that affect us, since you can use so many different people?
Well, I think that's going to affect you positively because, to be honest with you, most brokers will use a Chase, a Wells Fargo. Some of their jumbo products are great. But because we have access to all the jumbo products, a great example, I was doing a loan for an investor client the other day, and one jumbo product would not allow us to use the leases on his properties to help him with his income. So he had a bunch of different properties and he wanted to use the lease agreements to prove his income, but rather we had to actually use his pay slips that he was getting paid, like his bank deposits. And some people were using Venmo, and it was a nightmare because this one jumbo lender would not accept Venmo. So we had to move it to a different one who said, yeah, we can accept a Venmo statement. So very specific rules. And it's sometimes you don't even understand why they have these set rules. The advantage to using the broker is it's our job to know what these specific rules are and get to them before closing day, so that if we need to change a product, if we need to move the loan, we do it well in advance of the day before you're closing, and you get a phone call that says, hey, by the way, that document you gave us doesn't work and we're not closing today.
Well, that's why we need experts like you to keep us on top of all of these things. So I guess the next term we have would be, what are funding fees? So we talked a little about points, but what are funding fees?
Sure. So funding fees is a term generally used on FHA loans and VA loans. So, I mean, funding fee itself, I mean, a VA loan is probably most known for seeing that terminology, as opposed to a FHA loan calls it upfront mortgage insurance. So if we talk about the funding fee and the VA loan, I know we're not here to get into specifics of certain loans, but that loan, a VA loan, generally has a fee that you pay upfront. And that's kind of an insurance policy. And that's how they're able to offer 0% down on a lot of their programs. They're able to offer loans to people with lower credit scores in situations because they collect that funding fee. They kind of put it in a pool, and that's their kind of emergency. If something goes wrong with our loans, we've collected this insurance policy to help bail us out. So you'll see the funding fee, and in most VA situations, it varies tremendously depending on if it's your second VA loan or if you have a disability, but it's very common to be about 1.5% of the loan amount, and it's financed into the loan. It's not a cost you realize. And when that becomes a problem, I would say, or when you should be really conscious of it, is if you're in a situation where you're moving, you're in the one of the armed force services, and if you're moving from base to base and you're buying and selling, well, that fee goes to the cost of the house. So when you sell it, you lost that money. So it's just something to be cautious of. And in most instances, if you're there more than a year, the appreciation of the home more than covers that.
Yeah, and
go ahead. I'm sorry.
I was going to say, I think when you work with a broker, at least I've had this experience thinking I was going to go in with, an FHA or a VA loan, but they, when the numbers trickle down the spreadsheet coming to, how much I'm eventually going to owe in my final, payment, you sometimes can get deals that are, maybe you would make a different decision because that funding fee really does factor in, even if you have a lower or a higher interest rate, or maybe you have the money to put down, but you were maybe thinking you wouldn't use it. So that's where I think it's so valuable to have a lender that will show you all these different scenarios, because sometimes what you think your scenario needs to be ends up not being what you decide.
Yep, I agree 100%. We do something that's very, you should, if you're working with a broker, you should talk about a break even number. So and that's mostly when we're talking about points where you're paying extra for a lower interest rate. So let's say you pay $1,000 extra for your $1,200. We'll make the math easier. You pay $1,200 extra for a lower interest rate, and you're saving $50 a month. Well, that's going to take you 2 years before that extra money up front saves you in the long run. So now you have to decide, well, is this a house I'm going to stay in for more than 2 years? What's my long-term plan with this house? Am I turning it into an investment property, or am I going to need to leverage it to move to the next house? So these are things we go through with people to help them understand. And funding fees fall into that same category. Is it worth it to spend a 3% funding fee if we're moving in 6 months? You may be upside down in your house if that's the situation, meaning upside down, meaning you owe more than the house is actually worth.
Yeah.
So all things to be careful of.
So, well, the funding fee sounds like it's very much, an insurance for the lender for maybe benefit that is given to the borrower, whether it's a lower interest rate or maybe a down payment that's less. What is PMI?
Sure. So PMI is private mortgage insurance. So what that is when a conventional loan, okay, when you put less than 20% down. So for years, you had to put 20% down in order to buy a home. And then sometime back in the 80s, they came up with this idea that said, well, what if we made people pay into an insurance policy to protect the lenders, and they could put a little less down, but they're going to pay into this insurance policy on the side until they get to where they need to be. And everyone thought that was a great idea to encourage home ownership. So since then, we've had private mortgage insurance on loans that are, when you put less than 20% down, based on your credit score and some other factors like how many people are on the loan. And, we plug it into a system and it basically tells us what the private mortgage insurance should be. Okay. And there is some variation. Some people have slightly better rates, like some lenders do, but basically it's based on your credit rate, your credit score, and how much money you're putting down and how many people are on the mortgage. Now, that should not discourage you from buying a home. Private mortgage insurance can be very affordable. In some instances, it only adds like $50 to $100 to your payment. And the appreciation of homes are so much quicker than that. And you're not throwing away your money on rent or, like you're not building wealth. So I think that PMI should never be a deterrent from purchasing a home, and rather it's a tool to help you.
Let's talk about PMI for a few more minutes. I just want to ask a couple questions.
Sure.
Can you get PMI off? Like, I have it now. Am I stuck with it for 30 years, or can I get it off early?
Sure. So with FHA loans, the new rules, I believe, is the PMI is on the loan until you refinance out.
What about conventional? Like, there's conventional fiber.
Right. So
15%.
I was just going to get to that. So on the conventional side of things, you're absolutely right. So once you cross over that threshold of 20% you have 20% equity, there's a couple different paths to get it removed. One is when you sign your initial documents for your loan, there'll be a number in those documents that say, once you pay down your loan to X, your PMI will be removed. And typically that's 20% of the value at that time. The problem is sometimes that takes a little bit longer to achieve because homes are going up in value every year. So what people will do after having loan for a period of time is they will contact their lender and say, hey, homes now are worth quite a bit more in my area. I have more than 20% equity in it. Can I get my PMI removed? The lender will typically say, sure, let's order an appraisal, which you'll have to pay for. And as long as that appraisal comes in at this value, then we will remove your private mortgage insurance. So it's a pretty simple process. Yes, it sometimes does cost you a bit of money to go that route. An appraisal usually costs about $500 to $600, but over the course of a few months, it'll pay for itself.
Well, and that sounds like that's even more of a reason for it not necessarily to be a barrier, because it does have options on the back end as well for removing it or achieving a certain level of it being removed.
Yeah, like we forget our history so quick. I mean, PMI 100% was to enable people to buy a home who didn't have 20%.
Well, and sometimes it makes sense to not put down 20%. Like, I know everybody says put down 20%, 20%, 20%, but sometimes if your interest rate is 5% and you're making 10% in the market, it's smarter for people to keep that money, pay a little bit on PMI, and call it a day.
You couldn't be more correct. Especially over the last few years when interest rates were 3% and 4%, everyone was yielding more in the market. So it made no sense to put 50% down on a house. And a lot of times I want people to put things in perspective. I mean, adding $50 a month maybe for PMI, right? Because you have a good credit score. The difference in $10,000 is like $60 at current interest rates. So if you put $10,000 more, you're going to save $60 on your mortgage payment. It's not a significant number for most people. And I don't know about you, but I prefer to see $10,000 in my bank account for a rainy day than have it in my loan. Sure, it's equity. It's sure I'm going to have access to it. I'm building wealth, but it just does not give me that same sense of security. So I encourage first-time home buyers, second-time home buyers, have cash reserves. Don't put the extra. And guess what? In 6 months, if you're doing better, if you feel really good about it, put the other $10,000 down and get rid of the PMI. and everything's fine, but at least you can feel comfortable. Because what I think a lot of people forget is you buy a house, well, you're going to have to buy a lawnmower. You're going to have to buy curtains. You're going to have to buy furniture. And so there's unexpected costs that come up that 10,000 is definitely going to help you with.
Well, you're not even talking about the hot water heater. Like, we're looking at a house that, like, the hot water heater is probably at least 2013. And I know that my 3 children, age 5, 3, and 2, when they get into that bathtub with that hot water, like, I will be replacing it next month. Because yes, it totally passed, but those children and their baths, I mean, we can wear a hot water heater real quick. So, like, those are the things that, like, I can't tell you how many times we moved into a house and, like, it's passed inspection totally. But when we start living in it, especially since we bought it, in an estate sale or a foreclosure or something, that, like, it was fine, but, like, it breaks because it's been used. As my husband liked to say, the rust was keeping it together. So, there's a lot of unexpected occurrence of just, like, in the house itself, like appliances.
Yeah. So that's why cash is always a great thing.
And what about escrow or sometimes you hear escrow or impound account? What are those in the mortgage world?
Sure. So in the mortgage world, an escrow or impounds is basically how we ensure that your taxes, that mean your property taxes, and your insurance for the dwelling are paid each year. So, a long time ago, they came up with, hey, let's collect a little bit each month so that we can put it in this savings account and be able to pay those 2 bills for our clients. And they do it, 1, because it's a convenience for you, but 2, it's a huge protection for them, because really when they have a lien is what they put on a home when they give you a mortgage. And that means if something happens before you can sell the property, the lender has first dibs at it because they gave you that money. The only thing that can get in the way of that is a tax lien. So tax liens come first. So if for some reason you never paid your taxes for 10 years and then you try to sell your house, the government's going to take their money first, then the lender will get whatever's left over. So that's why we impound taxes, so that we make sure that those are paid so that we stay in the first position in that pecking order. The other thing about insurance, we do that because that also protects our investment. If you don't have insurance on your house and it burns down, what has happened to, your asset that we're basically have this mortgage on? We don't have anything. So those are the 2 things we impound. Some loans you don't have to impound, and a lot of times you have to pay a fee for that. Because I'll have clients who they say, well, I'd rather invest my own money. I'd rather make interest on that $2,000 over the course of the year rather than give it to somebody else. But I can tell you from experience that there's very small percentage of the population that budgets well enough to know when to pay their taxes and have that $3,000 ready and stay on top of their insurance. So it's something, as someone new in the mortgage industry shouldn't question. It's not to make money. They're regulated heavily as far as how much they can collect. And I think you have to trust the process when it comes to escrow.
So when you send in your mortgage payment, a portion of it will go to pay off the principal, the amount you owe. A portion will go to pay the interest for the bank or the lender allowing you to borrow that money. And then you'll have those escrow amounts that will be for your insurance, a monthly portion, and then your taxes, a monthly portion. And the lender is just holding that escrow money until your insurance bill comes through to them and they pay it, until your tax bill comes through to them and they pay it on your behalf. With that summary?
100% correct. And note that, you will get those bills sometimes in the mail. You don't need to pay them. Your lender will.
Might be worth a call to make sure that the lender has been put on as the person to receive those bills. I've had that happen.
Yeah, absolutely. If you change insurance companies, that's where you kind of run into that. A lot of people, because you are free to change your insurance through the years, and it's critical that you update that information so it can get paid.
So now that we've talked a little about, a little bit about some of the general terminology, we can launch into, I don't want to say complicated because I don't want to scare people. It's not complicated, but there are different types of loans that are available. So just in this introductory course of mortgages for landlords, can you touch base on just broadly some of the loan options that are available?
Sure. So maybe what I'll do is I'll introduce a few different types, and then I'll just go back and highlight 1 or 2 points from each of those types of loans.
That
Does that
sounds
make
awesome.
sense?
That sounds awesome.
So to start, the most common loan you're going to hear about out there is called a conventional loan. Okay. The next type of loan is an FHA loan. And these are in no particular order. I may be just kind of talking to them and as far as the number that are done out there. But I would say the second would be FHA. VA loans are also pretty prevalent. USDA loans. And then there's jumbo loans and non-QM loans. And we'll discuss what that means when I get to that. So let's start with the most broad, and that's conventional loans. 99% of you are going to fit into that category. Conventional loans are generally if you have good to great credit score. If you have 3 to 5% to put down, you'll qualify for that type of loan. For your primary home, what that means is that's where you live, that's your house where you reside, where you claim as your residence on your taxes, your primary dwelling. A conventional loan is probably going to be the best pricing, and almost, with good credit score, almost always that's the best choice. And the conventional loan is governed by two agencies, Fannie Mae and Freddie Mac, and they dictate a lot of the rules or the guidelines you might hear from different lenders as you go through the process. So what happens is they write up their rules, and when you apply for a mortgage, it's our job. And it's also what an underwriter, who we haven't talked about today, you're going to hear that term. The underwriter's rule is to make sure that everything you tell us is true, and that all of those truths fit into the rules of a conventional loan. So that's to sum it up as high level as I can. Things and reasons why you might not do a conventional loan would be maybe the loan's too much, that we talked about earlier, if it falls outside of the range in your specific area. And then also, if maybe your credit score isn't quite that good, that might be another reason why you don't go with a conventional loan. So that leads us to an FHA loan. So an FHA loan it's a loan that's governed by Freddie Mac or Fannie Mae. These are two large agencies that, monitor those guidelines, buy and sell mortgages, that sort of thing. An FHA loan is ideal for somebody who, once again, has a little less money to put down, whose credit score might not be the best. Maybe they have a little lower credit score. Maybe they had some trouble with some bills, so that's a great product for someone who's been struggling to keep their credit score up. Another thing with an FHA loan is if you have maybe some extra car payments or some extra credit card bills, it's a little bit more forgiving in something that we call your debt to income. What that means is the total amount of money you bring in versus the total amount of money that's going out to bills. FHA loans are a lot more forgiving than a conventional loan. Some of the downsides of FHA loans, it does have PMI, which generally doesn't come off, whereas a conventional loan with the private mortgage insurance, as we've talked about, will go away. But it also has something called upfront mortgage insurance. Because they feel like they're taking a little bit more risk, they add an upfront mortgage insurance fee to that loan. And that can be about 1.5 to 1.75% of the loan amount. That's financed. You don't have to come up with that money, but it is added to the amount of money that you owe. Now, before I continue, did you have any questions on things I've talked about there, or should I keep going through our list?
I think that is perfect. Between those types of loans, do the interest rates, are they pretty stable between those two types of loans, or do the interest rates swing wildly? Like, what does that look like?
Well, that's a great question. And interest rates can really depend on a lot of different factors. So if your credit scores are higher or lower, that's going to impact things. So if you have a really low credit score and try to get a conventional loan, your interest rate may be extremely high. Whereas if you, with that same credit score, same borrower, goes and gets an FHA loan, you may find that the rate is much more appealing because they have that forgiveness for the lower credit score. So it really depends. And a lot of times with our clients, we'll go through both scenarios to see what makes the most sense.
Okay. So it just seems like there's a lot of variables at play that you just really have to see what's available at that time and how your portfolio or how your credit fits into those molds.
Sure. And two other big loans there are the VA and USDA. And I don't mean to group them together because they're very different. But, if you have served in the military for a period of time, you will get eligibility, and it's a DD 214. We can go in once we have some information from you and see if you are eligible for a VA. A VA loan has a lot of benefits. There's no private mortgage insurance. If you have any type of disability rating, there's no upfront mortgage insurance. They are very lenient on your debt to income, just like an FHA loan. They're very lenient on credit score. So you're still going to get a great rate, even if your credit score isn't the best. So there's huge advantages, and they offer a zero down. So you don't have to put any money out of pocket to be able to buy a house. So it's a very, very powerful loan. And if you can use your VA on a home, in most cases, it's great. Now, some realtors tend to frown on VA because they do require a little bit more stringent appraisal. They're looking out for different things. If you've probably heard of a VA appraisal, but I try to challenge any realtor that has a tough time with it. If someone has served for our country and they've earned this benefit, then, who are you to say, because a little bit more work on your half, that you shouldn't accept their offer, and if they're not willing to see it that way, I think there's a bigger issue there. And a lot of times, what I'll do is I will call, and this is really important, whatever lender you work with, you want to make sure that they are willing to call the realtor after you put your offer in to talk about you, to say, you know what, I've seen all the documents. This isn't a guess. I've run the numbers. I've done our system. Here's the approval that our system got out. We just need to run this through an underwriter to check off everything, and this is going to be good to go. And guess what? My borrower could buy twice the house if they wanted to, but they're choosing to buy this because they're smart, they're savvy, and they feel this is a good price for this property, and that's something jumping all the way back to our broker versus bank. That's something you may not get a bank to do, or a teller to do, or an automated approval from online to do. A lot of people go online, get approval letter, and they think that's gold. But I've had a lot of conversations that have helped my borrower win a house, and the realtors were like, geez, I didn't know you did all that before. Thank you for backing up this piece of paper with a person.
Yeah, and then almost, in a way, professionally vouching for that pre-approval letter that you were willing to give them. It's not just printed on scrap paper. It really does mean a lot, and it comes from a place of due diligence.
Yeah, and sometimes I've even written a letter and said, my client is putting in an offer with a VA loan. However, they qualify for conventional, but they're using the benefit they earned through serving for 12 years so that they can do this. So if you feel like you need to deny it because of that, let me know and we'll go conventional. But if you want to honor their service, then, here's our offer.
Toe to toe. I like it.
I like
RJ.
that. That's awesome.
I feel passionate. I never served myself, but I feel that these people who've done it deserve the small benefits that they're getting after, the few.
Okay, so let's talk. You hear it all around of like, oh my gosh, I got this house because someone just bought furniture right before they were closing, or don't open a credit card, or like all of these things. So can you put all of those like warnings that you see in groups with some stories and context and explain that, and also help people keep from those pitfalls?
Sure. Let's talk about before you buy the house, things that you should avoid. Number one is a giant car payment. You don't want to be buying cars just before you're getting ready to purchase a home. I've seen people who wanted to buy their dream house and couldn't qualify because they bought their dream Raptor 2 months prior and they have a $1,700 car payment. I believe in spoiling yourself sometimes, but if the house is on the radar, you need to minimize that. Another thing that thou shall not, we used to send out the commandments, thou shall not, once you've submitted your file, do these things. Another big one is you don't want to make, you don't want to make major spends on your credit card. That's number one. The reason being is because if they see activity like that, they can take a look at new obligations. You don't want to open up any new loans or any new accounts. So you don't want to go to RC Willie's and do the never, never plan where you don't have to pay for 5 years, because that goes on your credit score. In a lot of instances, the people who are doing that are very close anyways, and that can throw off your debt to income ratio. You don't want to hide things thinking people aren't going to find it. Oh, well, I just kind of privately pay my wife support. It's nothing. And, that's not a big deal. Or I have a loan with this company that's not on my credit report, but it just comes out of my paycheck. These things they're going to find out. That's what an underwriter does. They're detectives. Their job is to find out if anything looks wrong with this loan. So you want to make sure that you're upfront, you're honest. You think of your broker as your lawyer. You can confide in them tell them what's going on so that they can tell you, well, no, we can't do this. Yes, we can do this. And no, you shouldn't do that. Getting back to your question, don't open up accounts. Don't buy cars just before you're going to do it. Don't create leases. Don't do anything. Don't move money. Don't have this secret stash of cash under your mattress and mysteriously put $10,000 into your bank account 10 days before closing. All of the money in the transaction has to be sourced. There's an anti-money laundering law that we're accountable to. So if mysteriously $10,000 that was your mattress money appears in your account and that's what you're banking on using for your down payment, that's a big no-no and you won't close. So you have to be very careful when you're sourcing, and a good loan officer is going to source that money before we get to that stage. He's not going to ask you where you're coming up with your down payment the day of closing, but I have seen things happen like that.
Now, usually when we're in the process of looking for homes, we're like, don't move any money.
Yeah.
Not that have mattress money, but just that it adds complication to the process, because then you have to show statements of where it came from to where it went, even if it's in your own circle of money. It's like, we can move money when it's, time to close, but don't touch anything.
Yeah, 100%. And trust the expert that you've enlisted for the service. So what I mean by that is if you put your faith in me to be your loan officer, you need to trust me. You need to know that I know more than you might know in this specific field, and I can navigate the waters and help you get through a transaction as seamless as possible. Little tricks, little things like, oh, you do have cash savings? Great. Let's put it into your bank, let it set for 60 days, and then it's okay. We can use that money, and rather than try to fool the system, I can tell you what is the legitimate way to do things.
So as we're wrapping up, I just want to do one thing. Can you walk us through the process? I know we've done this a couple times, both of us, but there's a lot of new people or newer people. So can you walk through okay, I want to buy a house. The very first step is I do what? And then all the way through the appraisal, the closing, just kind of do a quick 1 minute of how the process works all the way through for someone who either has never done this or only done this once or twice years ago.
Sure. Let's start with, you're sitting on your couch and you have the idea that I need to have a house, right? I'm going to be a little different than a lot of people here. I feel the first call you should make is to a good friend and say, hey, I'm thinking of buying a house. Who did you use? Someone who you trust to be your lender. That's where you should start. You should identify a lender to kind of see if it's a good idea. That's my opinion, right? Why waste a realtor's time showing you homes because the first thing a good realtor is going to do is come to my lender. You know what I mean? Make sure you're qualified, because I'm not going to show you houses until I know what you can afford and what you qualify for. So step one, go to a lender, understand, do an application. Don't be afraid of pulling your credit. I tell people this all the time. Everyone's like, no, don't pull my credit. I can't have my credit pulled. And I'm like, well, okay, I respect that, but are you not going to use your credit card anymore? Because every time you use your credit card, it impacts your credit score. If you put $500 on a card, it's going to impact you more than me pulling your credit. And if you're not pulling your credit every day, it's not going to significantly dip your credit score, okay? As long as it's not a trend. So start with an application. An application is basic information about you, and you are going through that, telling where you work, how much money you make, how much money you have in the bank, that sort of thing. Your lender can help you walk you through it. Once your application's done, we issue a pre-approval letter. That pre-approval letter then can hang with your realtor. They can have it. We can adjust it to the exact dollar amount, as you commented before, so that you're offering exactly what you want to offer. And when you said you want to walk through the process, do you want to go this micro, or do you want me to continue down this road? Or should
perfect. No, this micro.
Okay. I want to make sure that we're on the right track here.
No. We talked about this the whole time, and we've gone through all the different pieces, but I do think that there's people that get a little lost in the process. And so, I just wanted you to go through all the pieces so that someone understands what to expect.
Someone just learned, one of our viewers just learned that they don't need to go look at houses until they've talked to a lender. That is super valuable information in the sequence of events. So keep on.
Okay. And once again, the value of doing an application, people shouldn't feel like it's anything more than just to see if you qualify. You shouldn't be afraid of an application, because that's going to give you the information you need I think people treat it like going to get a cancer screen, like they're afraid to know, if it's no. Whereas I can find things that are wrong with you, with your financial situation and fix it so that when you want to buy a house in June, you're going to be ready to go, where ignorance is not bliss. If you go to do an application when you find, in June, when you find the perfect home and realize, oh my gosh, someone stole my credit card and racked up and my score is horrible. I'm going to need 30, 60, 90 days to fix that. And you're not going to have time. So by me pulling the credit, by me taking a look at financials, by me seeing that you co-signed for a car for your daughter, and that's screwing up the ability for you to qualify, I'd rather know that in January than in June. Because I can tell you, hey, if you make sure your daughter makes every payment over the next 12 months, then that won't count against you. If you can do this, then we can make sure that that's not going to impact your ability to qualify. So of all the steps I'm going to go through, go to a lender, fill out an application, get your credit pulled properly. Don't think you know it because you're looking at your bank. The mortgage pull is a little bit different, and let them guide you from that point as to what you need to do. And I don't care if you want to buy in 12 months, 6 months, or 2 months. That's the first step. You need to do that. Okay. Once you do that and you give them the documentation, the rest is fun. You're out looking at houses. You're seeing what you like, what you don't like. You know what you can afford. Your realtor's going to negotiate for you. So it's not work. It's just walking through homes and enjoying and trying to find and visualize how the rest of your life is going to go. From that point, if you will find a house, you're going to put an offer in, and your realtor is going to help you with that. You don't need to know anything about that. You're just going to have to agree on a price, and we know what's affordable to you. The offer is accepted, and then we go through our work, and our work is just validating everything you've told us in the application. We're going to ask you for documents. We're going to say, oh, well, you're paying child support. We need to see the actual divorce decree to make sure it's not 297, it's 298. That matters to us, detail. Those are the kinds of things that an underwriter is going to scrutinize. They just want to make sure everything you said is the truth and that it falls into the guidelines of the loan that you're applying for. It's as simple as that. Through the stage, we'll do things like order an appraisal. You will order an inspection of your home to make sure that you're satisfied with the condition of it. Once you feel good about that, we'll continue to go through the process and eventually get to something called closing. And that closing is where you sign the final loan documents that state, yep, I agree to this terms. I am okay with this interest rate. I am ready to buy this house. Here is my down payment, and let's move forward. And then we close on the house. So many things are done for you, like paying your taxes, paying your insurance. It's a real easy process.
And during this process, it's the borrower isn't having to guess what to give the lender. The lender is reaching out saying, okay, at this week, I need, your bank statements, or, okay, we're calling appraisal this week. We'll get back to you. A good lender is walking a buyer through this. They're not having to know all of this on their own, right?
Right. Yeah. And 100%. And what we are is the go-between between the underwriter and the client. So we try to make things as easy as possible. The underwriter says, oh, these pay stubs are actually 45 days old. The guideline says they have to be within 30. So, the biggest thing I could say is be patient with your lenders. If they ask you for something that you feel you've already provided, provide it again, because the reality is someone's asking them for that document that maybe the corner was clipped off. Maybe you didn't give them the blank page of your bank statement that you felt and I feel is not necessary, but because it says 1 of 5, the underwriter, because of their job, has to look at all 5 pages. So, give a little bit of leeway when we're asking for things, because we're just trying to make sure that the loan's compliant, just trying to make sure that we can cross all the T's and dot all the I's. That's the biggest thing.
And so do you feel like from an introductory level, is there anything that we have missed?
I think the things that we have probably haven't touched on from an introductory level that may not be as critical is we didn't get into the realm of non-QM mortgages. And that might be a term people hear that they want to know more about. Non-QM, if you hear that term, what that means is non-qualifying mortgage. That means that mortgage is not governed by Fannie Mae or Freddie Mac. It's not a conventional. It's not an FHA. It's not a VA. It's not a USDA. It's a bank that had a lot of money and they said, you know what, we're going to put together a product. We're going to have a higher interest rate, but maybe it's going to help this person who's self-employed, who only wants to give us bank statements to prove their income instead of their tax returns. Maybe it's going to help this investor who wants to buy an investment property and use the merits of that property, meaning the rent that it collects, to qualify for the income, because they don't make a lot of money, but they feel that property could, and they have enough to put a down payment. So that bank, it's non-QM, it's not qualifying for the government programs, can now say, here's our guidelines for that home. Here's what we need from you, and we feel comfortable. If you give us 30% down, we're going to look the other way on a lot of things because we feel that our investment's safe. So, if you hear that term, you may hear DSCR, you may see AirDNC. There's a lot of different terms flying out there, and they're fancy terms for just renaming non-QM products, which are specialized products, most time only available to people who have large down payments, but nonetheless, they're valuable in certain circumstances. And just to be clear, we talked about jumbo loans. A jumbo is technically a non-QM product. Even though it follows a lot of the guidelines of a conventional loan, it's typically a non-QM.
Okay, well, we really do appreciate having you with us and sharing your knowledge and time. Could you tell our viewers, just remind us your name of your company and what states you operate in?
Sure, absolutely. Well, my name, once again, is RJ Colosimo, and I'm sure you'll maybe see something fancy, once we post edit it up. I work with Summit Home Loans. We're licensed in most of the states to do loans. Different products allow us, like some of our non-QM products, we can do anywhere. Other products, some of the qualifying mortgages, we're a little bit more limited. We're located in Utah. We do a lot of loans in California. We're also doing loans in Florida. If you are in a certain area, we have a lot of affiliates we can refer you to who will give you the same type of treatment that you're going to get from us. A big tagline that we use in the broker world is brokers are better. So we like to support each other, and we're going to find you a good broker and wherever you're shopping to make sure you get the right service. And also, we're quick too. Like we're really good at closing loans in a timely fashion. So I would say, if in question, give us a call. We can direct you. We can guide you to what's going to be the best person to start with.
Perfect. Well, we really do appreciate your time today, and we will share your contact information with our viewers so that they can reach out to you with any questions.
Great. Well, it's been fun to be here. Thank you so much.
Thank you for coming. Appreciate it.